Joining me now, former White House chief economist, SNBC, their chief economist, Joe LaVorgna. Joe, it's interesting thinking about this meeting. There was an encounter the last time Jay Powell was on Capitol Hill with Democratic Congressman Richie Torres out of New York. It was really intriguing. I want you to take a listen. I want to ask you about this.
In the pre-COVID world, we had the best of both worlds: low unemployment, low inflation for decades. Do you believe that we could return to that best of both worlds, or high interest rates a new normal in the American economy?
So we will return to 2% inflation and maximum employment. What will be the level of interest rates there? That's a really good question. And
do you suspect it's going to settle at a higher level than we've known historically?
I think it's really hard to know.
All right, so two things there. First, I don't know if he meant to, but Torres gave Donald Trump and you some credit, right? He said you guys had the best economy because that was pre-COVID. Also bringing up this notion of 2%, right? This more and more folks on both sides of the political aisle are saying this 2% target, it might be a mistake. Considering you're going to be higher for longer and those sort of things, do you think the Fed actually start to consider maybe a 3% target or no targets at all?
A lot to there, Charles. On the economy, I think the success of the Trump economy was largely a tax and regulatory pro-business approach. Small business sentiment had been higher during the first year of a Trump administration than any other prior administration.
By the way, it rocketed in November. After the election, it went crazy.
That's right, Democrat or Republican. And my colleagues, Kevin Hassett and Tyler Goodspeed, put out a very nice piece that talked about the accumulated wage gains of average household income in 2 years, in 18 and 19, after the tax cut, the TICJA, Tax Cut and Jobs Act of 2017 was passed. The average household made $5,000. That is more cumulatively than the previous 8 years.
Right.
So there were some really good things going on. Now, if the economy is growing and it's productivity-led, because under the Trump economy, every year productivity growth did incrementally rise. That was a function of very strong business investment. That will help lower inflation because the supply side or potential ability of the economy to produce the things we want grows. That will help us get 2% inflation. So the question is, do we get to the 2% inflation that Jay Powell and his colleagues want because demand collapses, which would happen if the unemployment rate rises sharply, or can we do it through some combination of taking away the excess money, but also increasing the supply side of the economy? Unfortunately, I don't see administrative policy moving anywhere in that direction, but rather the opposite.
So there's not going to be an administrative help. So does Powell recognize that and say, okay, this is nuts to be insist on 2%? Let me just share one other thing with the audience while you ponder that from Apollo. The lag effect, the negative impact to our GDP. So it begins in the third quarter, right, into next year. Some serious impacts. So you've got these serious lag effects that are going to naturally hurt the economy anyway. So why keep pounding away? Why keep, with extremely hawkish policies if that's coming online anyway? And by the way, people are getting used to a higher level of inflation.
Charles, I ask a lot of former Fed people, colleagues of mine, I say, who was the vice chair under Arthur Burns? Do you know the vice chair of Arthur Burns?
No.
Nobody does. And why does that matter? Because Jay Powell is going to have a lot of pressure on him next year in a presidential election year and keeping policy tight because the board has, I would argue, become more dovish. And with an election coming, a very important election, there's going to be a lot of pressure on him to do that. One of the ways you might be able to massage the outcome is to say it might take longer to get to a 2% target. Now, in the Fed's forecast, it's 2025. I actually am more of the inflation transitory camp, believe it or not, and do expect inflation to move down quite sharply. In fact, if you take shelter out, which are those rents which will come down, we're only running 2.6 on the core CPI.
The bottom line, then, you're saying is that whether he says 3% or not, he's going to have to put the brakes on.
Yeah, I like what Julia said earlier. They'll keep rates higher for longer if need be. They will take a flexible, data-driven approach. This isn't going to be the pain speech he gave last year. This is going to allow him flexibility to move because if the next employment report is soft, the market's going to be clamoring for year-end easing, believe it or not.
Great stuff, Joe.
Thank you, Charles.
Thank you very much.